Hey guys, Jared here. Quick video run you through carry forward super contributions. This is a very valuable strategy if you're eligible and if you've got the resources to put it into place. So what is it? It is the ability to take your unused concessional contributions from over the last 5 years and bring it forward into this year and significantly increase your concessional contribution allowance, basically allowing you to dump a whole lot of money into super if you're able to do that and it works for you, and save a whole heap of tax. So how does it work? Concessional contributions. So these are the types of contributions that go into your super. Your employer contributions, salary sacrifice, or deductible super contributions. And there's a cap on how much you can generally do each year. It ranges anywhere from, currently it's 30,000 and did range down from 27 and 25,000 a year. So any amounts that you didn't use up to that cap over the last 5 years all accumulate together and carry forward into this year if you're eligible. How are you eligible? Your super has to be under $500,000 basically. What are the benefits? Rather than paying tax at your marginal tax rate, which might be anywhere 30% to 45%, the tax rate in super is 15%. So I've got a case study later in this video. I'll show you the benefits in more detail, but basically saving you a lot of tax. What to watch out for? So as I mentioned, there's the concessional contributions. You don't want to go over that cap. Otherwise, the penalties aren't as great anymore as to what they used to be. There is no penalties, but it's just a pain having to deal with the ATO and get it fixed up sometimes. But we want to make sure we don't go over that cap, essentially. But one thing to watch out for, as I mentioned before, to be eligible is having $500,000 in super. Now, some people, they might be at $480,000, about to go over it. So they might have one last year to put as much in and take advantage of this. But that doesn't mean that once you go over, you're never eligible again. So in some instances, we're able to get people back under. So the following year, they can take advantage of it. How they might do this, you can do this through super splitting with your spouse. You can withdraw money if you're eligible in the right age through a transition retirement income stream. They're the two main ones. You pay for insurances through super and pay for financial advice fees, which could get it back under if you're just right on the edge. So how to check? So you log into your MyGov account, and then you go to if you've got the ATO links, the Australian Taxation Office, you go to that, and then within there, this is my portal. So you click on super, and then you come down to information, and then you'll find carry forward concessional contributions right there. Click on that, and it'll open up this section for you. So my super is under the 500,000, so I'm eligible. There's a nice green eligible box there, and it tells you what is your unused concessional contributions available to carry forward into this financial year. So keep in mind that you will not tap into using any of these unused amounts until you've used up this year's cap first. And then you can see here, it'll go into detail as into how much you've got left over for each financial year. So as I said, it'll use up this current year first, and then it'll revert back to the oldest year and use that first or next. That's the one that'll be dropping off if you don't take advantage of that as each year rolls on. So here's a case study to give you an idea. Bob, obviously we changed the name, had $450,000 in super, so getting close, had an income currently of $130,000 in this year, and had been earning about that over the last 5 years, and had never put any additional super contributions into his super fund. So what we did, we looked up how much his available carry forward concessional contributions were. $60,000 was that figure, plus this year of another $15,000, giving him a total of $75,000 that he could potentially contribute to super, and then claim a tax deduction on it. So the outcome, because this $75,000 was claimed as a tax deduction, making it a deductible super contribution, his assessable income, so when he went and did his tax return, rather than it being $130,000, it became $55,000, so $75,000 less. So he'd been paying all this tax the whole year based on someone who earns $130,000, so he's got a big tax return back. And the overall net tax saving, so when we factor in what the tax paid in super as well, 15%, $12,750 was saved in tax. But where do I get the money from? It's not easy just to pull $75,000 out of thin air. So you need to have savings, term deposits, or redraw money in your home loan that you can withdraw back out, knowing full well that you're going to pay it off quickly. Or a TTR, which is a transition to retirement income stream for those people aged over 60 and still working. It's where you can access part of your super each financial year. 10% of the account balance is the maximum amount. But I've got some other videos in relation to that to go into a TTR in more depth if you want to see that. Anyway, thanks very much for watching. Hopefully that has been of value. And as always, this article was just general advice only, not personal advice. Thank you.